So a new rule means that 401k contributions will no longer be tax deferred. And I'm honestly shocked by this, but I'm not surprised. This will apply whether you're saving through a 401k, a 403b, a 457b, a SEP, or even a simple IRA. So here's what you need to know. If you're over 50 and earning more than $145,000 in FICA wages, the IRS just changed how you save for retirement. Starting in 2026, every catch-up contribution you make to your 401k will have to go into a Roth account, meaning no more pre-tax shelters for those extra savings. You'll pay tax now and nothing later. And the reason for this may surprise you because for decades now, retirement savings ran on a simple idea. You defer your tax, you grow the balance, and you pay that tax bill later. You took the deduction today, invested the difference, and promised the government you'll pay up someday in retirement. That's what we call the pre-tax model, right? The traditional 401k. And the Roth model is the complete opposite. You pay the tax today, then your money compounds untouched. Withdrawals later are completely tax-free. But the new rule forces high-earning savers into the Roth lane for their catch-ups automatically. And now the government gets tax revenue now instead of waiting 10, 20, or 30 years. So for you, that means less take-home pay today. And for the IRS, well, it means faster cash flow. So let's look at what the rule actually says. Here's the fine print stripped of any BS. It affects anyone age 50 or older who earns more than $145,000 in FICA wages. It applies to the $7,500 catch-up contributions you can make on top of regular 401k limits and additional limits if between 60 and 63 years of age. Now, starting January 1st, 2026, those dollars must be Roth contributions, which is post-tax. Now, your regular 401k contributions can remain pre-tax, and 93% of workplace retirement plans do offer a Roth 401k option, but 7% don't. So if your employer's plan lacks a Roth feature, you won't be able to make catch-up contributions at all once this rule takes effect, even though you're eligible by age. So be sure to check with your HR department as soon as possible. The IRS delayed the original 2024 start date because payroll systems and retirement platforms just weren't ready. Now, everyone has until 2026 to prepare for this. Now, you may be asking yourself, what is the point of this change? Well, every new tax rule walks a tightrope between policy and politics. And from a policy standpoint, well, the government needs predictable revenue. The nation has trillions sitting in tax deferred accounts, and that money doesn't fund today's budget. So the Roth catch-up rule accelerates when those taxes are collected. And from a political standpoint, it's an easy sell. As it doesn't raise taxes, it just changes when you pay them. And since it applies only to higher income earners, most voters never feel it. So let's take a look at the change in more detail. Here's a very simple example so you know exactly how this affects you. Suppose you earn $180,000. You contribute $7,500 in catch-ups. Before, that reduced your taxable income to $172,500. But after 2026, you'll pay income tax on the full $180,000. And if your marginal tax rate is 24%, that's $1,800 more in taxes for 2026. Now, the trade-off here is that your Roth contribution grows and compounds tax-free forever. Now, some will be happy about this and some won't, but this isn't purely good or purely bad. It creates different winners depending on your situation. So let's look at the downsides. You'll owe more federal taxes now because you lose the pre-tax treatment on catch-up contributions. If you're making $7,500 in catch-ups and you're in the 24% tax bracket, as we said, that's $1,800 more in taxes this year. Your take-home pay shrinks slightly. You're also paying taxes during your peak earning years when your rate might be higher than it will be in retirement. And nobody knows where tax rates are headed. Now, the upside. Once your money is in a Roth, it grows tax-free and can be withdrawn tax-free. Even better, thanks to Secure 2.0, Roth 401k contributions are no longer subject to required minimum distributions when you turn 73. Your traditional 401k will force withdrawals your Roth won't. And when you retire, having a pool of tax-free money gives you flexibility. You can manage your taxable income more strategically, potentially keeping yourself in a lower bracket or reducing how much of your Social Security gets taxed. So the key question here is, will your tax rate be higher later or higher today? Since no one knows, it's pretty smart to diversify between post-tax and pre-tax accounts. Now, how to prepare before 2026. This is where strategy matters. Don't wait for HR to figure it out. Step 1, you want to verify your plan. Ask your employer if your 401k includes a Roth option. If not, they'll need to add one before 2026 or your catch-up stop entirely. Step 2, estimate the tax hit. Multiply your catch-up contributions by your marginal tax rate. That's roughly how much you'll owe once the rule takes effect. Step 3 is to adjust your withholdings. Smooth that impact by spreading that extra tax over each paycheck instead of being surprised at year end. Step 4 is to balance your contributions. You can still split regular contributions between pre-tax and Roth. So diversify by paying some tax now and deferring some for later. And step number 5 is to talk to your tax planner. You want to run projections on future income, tax brackets, and Social Security timing. The Roth rule might actually help you reduce future RMDs, lowering long-term taxes. So what does this mean on a broad scale? This rule isn't an isolated update. It's part of a much larger shift, what policy analysts call Rothification. The government has been quietly steering retirement savings toward Roth structures for years. Expanded Roth 401k access, higher Roth IRA contribution limits, Roth treatment for employer matching contributions, and now mandatory Roth catch-ups for high earners. And why? Because Roth accounts don't create future liabilities for the Treasury. Every dollar taxed today is a dollar the government doesn't have to worry about later. This makes federal budgeting cleaner. It also aligns with generational fairness. Current taxpayers help fund current obligations rather than passing them forward. And over time, this could redefine how retirement savings work altogether. The classic tax deferred until 70 and a half model is being replaced by a pay now, own forever system. Expect more Roth integrations across retirement systems and 401ks. IRAs, and even public pensions. Heck, expect more rules that accelerate tax collection without raising rates. And expect retirement planning to feel more like tax timing than tax avoidance. And if you're a little bit worried, here's how you can make opportunity out of this change. Roth contributions create tax-free compounding. So once money is in, it's yours, no future tax, no RMDs, no surprises. For higher earners, it can also be a hedge against legislative risk. If Congress raises taxes in 10 years, your Roth balance is untouchable. And some might think of this as a psychological win. Knowing your withdrawals won't trigger a tax bill changes how confidently you can spend in retirement. And there's a hidden benefit for younger workers. Even if you're not affected yet, this rule signals where policy is heading. Roth accounts will dominate future retirement system. Younger workers can now take a hint there. Pay your taxes early in your career when your rate is lower. Build tax-free growth for life, and never depend on the government's future promises. That's the cleanest hedge against uncertainty. And when your generation retires, hopefully you won't be watching Congress debate how much of your nest egg they get to tax. So looking forward, think of your retirement plan as two engines. One runs on pre-tax fuel, the other on post-tax. The pre-tax engine gives speed today. The post engine gives endurance tomorrow. So this Roth catch-up rule simply forces you to add more fuel to the second one, more towards tax now and no tax later. So the question isn't whether this is good or bad. It's whether you're prepared. The rule favors the informed, the proactive, and the patient. So use the next year wisely. Audit your plan, rerun your numbers, and understand how the tax timing of your savings align with your future lifetime goals. Because the future of your retirement isn't about if you'll pay taxes, it's about when and on whose terms. Hopefully this was helpful. My name is Karan, and I'll see you in the next video.